There's something happening in the silver market right now that most investors are completely missing. And I'm not talking about the usual supply and demand dynamics or industrial usage statistics. I'm talking about a specific event that just occurred, one that historically has preceded massive silver price explosions, the kind that turn modest positions into generational wealth. Let me show you exactly what I'm seeing, because once you understand this pattern, you'll realize why $200 silver isn't just possible, it might be inevitable. Here's what caught my attention. Central banks just reported their highest quarterly gold purchases in over a decade. You might be thinking, wait, you said this was about silver. Stay with me, because this is where it gets interesting. Every single time in modern history that central banks have gone on aggressive gold buying sprees, silver has followed with moves that dwarf gold's percentage gains. We're talking about silver outperforming gold by ratios of 3 to 1, sometimes 5 to 1. But there's more to this story. While everyone's watching the gold headlines, something extraordinary is happening in the physical silver market that almost nobody is talking about. The London Bullion Market Association just reported that available silver inventories have dropped to levels not seen since the early 2000s. We're talking about a 40% decline in registered silver stocks over the past 18 months. Now let me paint you a picture of what this really means. Imagine you're running a warehouse, and every month more trucks are showing up to take product out than are bringing product in. At first, you've got plenty of inventory, so no problem. But month after month, the shelves get emptier. Eventually, you hit a point where you simply can't fulfill all the orders coming in. That's exactly where we are with silver right now. The industrial demand side of this equation is absolutely staggering. Solar panel manufacturers alone are projected to consume over 200 million ounces of silver annually within the next 2 years. That's nearly 20% of total global silver production going to just one industry. Add in electric vehicles, 5G infrastructure, medical applications, and traditional electronics, and you're looking at industrial demand that's growing at roughly 15% per year. But here's where this gets really interesting, and this is the part that connects back to that secret event I mentioned. The Chinese government just announced a massive infrastructure spending program focused on renewable energy and advanced manufacturing. We're talking about a multi-trillion-dollar initiative, and every single component of this program is silver-intensive. Solar panels, electric vehicle charging stations, smart grid technology, advanced semiconductors, all of it requires significant amounts of silver. Now, China is already the world's largest silver consumer. They're importing record amounts of physical silver, and their domestic production can't keep pace with demand. So what happens when the world's largest consumer suddenly ramps up their consumption by another 30 or 40%? You get a supply crisis. Let me tell you a story that illustrates exactly what I'm talking about. Back in 2010, there was a small industrial manufacturer in Germany that used silver in their production process. Nothing fancy. They made specialized electrical components. They had a standing order with their supplier for regular silver deliveries. Everything was running smoothly until suddenly, in early 2011, their supplier called and said, "We can't fulfill your order. There's no available silver at the price we quoted you. If you want it, you'll have to pay 60% more." This company had two choices: shut down production or pay the premium. They paid. And you know what happened to silver prices during that period? They went from around $18 an ounce to nearly $50 in less than 6 months. That's a 177% increase. And it wasn't because of some speculative bubble. It was because physical silver became genuinely scarce. We're seeing the early warning signs of that exact same scenario playing out right now, except this time, the scale is exponentially larger. The industrial demand isn't coming from small manufacturers. It's coming from entire nations rebuilding their infrastructure around silver-intensive technologies. Now, let's talk about the investment side of this equation, because this is where things get truly explosive. Silver ETFs have seen consistent inflows for the past 8 quarters. But here's what's fascinating. The pace of those inflows is accelerating. In the most recent quarter, silver ETF purchases increased by 35% compared to the previous quarter. That's not a gradual trend. That's institutional money starting to move in size. And when I say institutional money, I'm not talking about retail investors buying a few coins. I'm talking about pension funds, sovereign wealth funds, and family offices allocating serious capital to physical silver. These are the smart money players who don't chase trends. They position ahead of them. There's a fund manager I know who runs a $2 billion portfolio. Very conservative guy, mostly bonds and blue chip stocks. Last month, he told me he just allocated 8% of his fund to physical silver, When I asked him why, he said something that stuck with me. The math doesn't work anymore. Either silver prices go up dramatically or the industrial economy stops functioning. Those are the only two outcomes I can see. Think about what he's saying. Silver is trading at around $30 an ounce right now. The cost to mine silver, when you factor in energy, labor, and equipment, is approaching $25 an ounce for many producers. That's a razor-thin margin. Several major silver mines have already announced they're scaling back production because it's not economically viable at current prices. So you've got surging demand, declining inventories, and producers who can't afford to increase supply. This is the textbook definition of a supply-demand imbalance that can only resolve one way, through significantly higher prices. But let's dig deeper into that secret event I mentioned at the beginning, because this is where all these threads come together. The event I'm referring to is actually a series of coordinated policy decisions by central banks around the world. They're not just buying gold, they're fundamentally restructuring their reserve holdings away from dollar-denominated assets. The implications of this are profound. When central banks diversify away from dollars, they're essentially saying they don't trust the long-term stability of the world's reserve currency. And historically, when confidence in fiat currencies erodes, precious metals don't just go up, they explode. Here's a specific example that demonstrates this pattern. In 1971, when Nixon closed the gold window and ended dollar convertibility to gold, silver was trading at around $1.50 an ounce. Within 9 years, it hit $50. That's a 3,233% increase. Now, I'm not saying we're going to see that exact percentage gain, but the underlying dynamics are remarkably similar. We're in an environment where governments are running unprecedented deficits, central banks are trapped in a cycle of monetary expansion, and real assets are becoming increasingly scarce. Silver sits at the intersection of all these trends. It's both a monetary metal and an industrial commodity. That dual nature is what makes it so explosive during periods of monetary instability. Let me share something with you that most people don't realize. The total value of all the silver ever mined and still in existence is roughly $1.4 trillion. That sounds like a lot until you compare it to the $13 trillion in U.S. money supply or the $300 trillion in global debt. Silver represents a tiny fraction of global wealth. If even a small percentage of that wealth tries to move into physical silver, the price impact would be astronomical. There's a concept in markets called inelastic supply. It means that no matter how much the price goes up, you can't quickly increase the supply. Silver is one of the most inelastic commodities on the planet. You can't just flip a switch and mine more silver. It takes years to bring new mines online, and most of the easy-to-access silver has already been mined. Now, I want to talk about something that's relevant if you're thinking about your long-term financial security. A lot of people are sitting on retirement accounts, 401ks, IRAs, and they're watching the purchasing power of those dollars slowly erode. There's actually a way to hold physical precious metals inside a retirement account without triggering taxes or penalties. It's called a gold IRA, and it works with silver too. I put together a free guide that explains exactly how this works. It's in the description below. If you've got $100,000 or more in retirement savings, it's worth understanding how this strategy works. No pressure, just information, if it's relevant to your situation. All right, back to where silver prices are headed because the technical picture is just as compelling as the fundamentals. Silver just broke through a major resistance level that it's been testing for the past 3 years. In technical analysis, when you see a multi-year resistance level break, it often signals the beginning of a major trend change. The last time silver broke through a similar multi-year resistance level was in 2010. What followed was that explosive move to $50 I mentioned earlier. Now, past performance doesn't guarantee future results, but patterns in markets exist because human behavior is remarkably consistent. Fear and greed drive the same types of moves over and over again. Here's what's particularly interesting about the current technical setup. The breakout is happening on increasing volume. That means it's not just a few speculators pushing the price up, it's broad-based buying from multiple types of market participants. When you see breakouts on high volume, they tend to be more sustainable and lead to larger moves. Let me tell you about a conversation I had with a commodities trader who's been in the business for 30 years. He told me that in all his years of trading, he's never seen a setup quite like what we have in silver right now. The combination of technical breakout, fundamental supply shortage, and monetary policy backdrop is, in his words, a once-in-a-generation opportunity. Now let's talk about what $200 silver actually means and why it's not as crazy as it might sound. At $200 an ounce, silver would still be below its inflation-adjusted all-time high from 1980. When you account for inflation, that $50 peak in 1980 would be equivalent to over $180 in today's dollars. So $200 silver isn't some wild speculation. It's actually just silver catching up to where it should be based on historical precedent and inflation. But there's another way to think about this. The gold-to-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 60 to 1 throughout history. Right now, it's trading at roughly 85 to 1. That means silver is historically cheap relative to gold. If gold is at $2,500 an ounce and the ratio returns to its historical average, silver should be trading at around $42 an ounce. And if gold continues higher, which many analysts expect, silver could easily reach $60, $80, or even $100 just from the ratio normalizing. But we're talking about $200 silver, which implies something more than just ratio normalization. It implies a genuine supply crisis combined with a monetary crisis. And the evidence suggests both of those scenarios are not just possible, they're probable. Let me walk you through a specific scenario of how we get to $200. First, industrial demand continues growing at 15% annually, which is conservative given the renewable energy build-out happening globally. Second, investment demand doubles as more institutions and individuals recognize the supply shortage. Third, mine supply stays flat or declines slightly due to economic constraints. Fourth, above-ground inventories continue depleting at current rates. If those 4 things happen, and all of them are already in motion, you get a situation where demand exceeds supply by roughly 250 million ounces annually. That's a massive deficit. To close that gap, prices have to rise enough to either stimulate new supply or destroy demand. Given the inelastic nature of both supply and demand in silver, the price adjustment required could be dramatic. There's a mining executive I spoke with recently who runs one of the largest silver operations in Mexico. He told me that even at $50 an ounce, they couldn't significantly increase production in less than 3 years. The infrastructure, permitting, and development timelines are just too long. So if we hit a genuine shortage, there's no quick fix on the supply side. Now let's talk about what happens when shortages hit commodity markets. There's a phenomenon called backwardation, where the spot price of a commodity trades higher than the future price. It's a signal that people need the physical commodity right now and are willing to pay a premium for immediate delivery. Silver has been flirting with backwardation in certain markets, which is extremely unusual for a commodity that's supposed to be abundant. I want to share a story that illustrates what happens when physical shortages meet paper markets. In 2008, there was a brief period where you couldn't buy physical silver coins at any price, even though the paper price of silver was crashing. Dealers were sold out, mints couldn't keep up with demand, and premiums on physical silver exploded to 50% or more above the spot price. That disconnect between paper and physical is a warning sign that the paper market isn't reflecting true supply and demand. We're starting to see similar dynamics today. Premiums on physical silver coins and bars have been elevated for months. Delivery times from major dealers have stretched from days to weeks. These are the early warning signs that physical silver is becoming scarce, even though the paper price doesn't fully reflect it yet. Here's something that should concern anyone paying attention. The COMEX, which is the major exchange for silver futures, has seen its registered silver inventories, the silver actually available for delivery, drop to multi-year lows. At the same time, open interest in silver futures has been rising. That means more people have claims on silver than there is silver available to deliver. This is a recipe for a short squeeze. Let me explain what a short squeeze looks like in silver. Traders who are betting on lower silver prices have to borrow silver to sell it. If the price starts rising instead of falling, they're forced to buy silver to cover their positions and limit their losses. But if there's not enough physical silver available, they have to pay whatever price necessary to close their positions. This creates a feedback loop where rising prices force more buying, which pushes prices even higher. The last major silver short squeeze happened in 2011, and it drove prices from $26 to $50 in just a few weeks. The current setup has even more potential because the physical shortage is more severe and the amount of paper silver outstanding relative to physical silver is higher. Now, I want to address something important. Some people hear these price targets and think it's just hype or speculation. So let me give you the bear case, the reasons why silver might not reach $200. First, industrial demand could slow if we hit a global recession. Second, above-ground inventories might be larger than reported. Third, recycling could increase significantly at higher prices. Fourth, substitution could occur in some industrial applications. Those are all valid concerns. But here's why I think they're outweighed by the bull case. Even in a recession, the renewable energy transition continues because it's driven by government policy, not just economics. The inventory data comes from official sources and has been audited. Recycling is already near maximum levels for most applications, and substitution is extremely difficult for most of silver's industrial uses because of its unique properties. Silver is the most conductive metal, the most reflective metal, and has unique antibacterial properties. You can't just swap it out for copper or aluminum in most applications without significant performance degradation. This is why industrial demand for silver is considered relatively inelastic. Companies need it regardless of price. Let me share one more story that ties all of this together. There's a billionaire investor who made his fortune in technology. Very rational guy, not prone to speculation. A few years ago, he started accumulating physical silver, not silver stocks or ETFs, actual bars stored in secure vaults. When asked why, he said something profound. In a world where everything is digital and can be created with a keystroke, physical silver is one of the few things that's genuinely scarce and genuinely useful. That perspective captures why silver is so compelling right now. We live in an era of infinite monetary expansion, but finite physical resources. Silver sits at that intersection. It's money, but it's also a critical industrial material. It can't be printed, it can't be digitally created, and it can't be easily substituted. The path to $200 silver isn't a straight line. There will be volatility, pullbacks, and moments of doubt. But the underlying fundamentals are building toward a price reset that could be historic. The combination of industrial demand growth, investment demand acceleration, supply constraints, and monetary instability creates a perfect storm for silver. Think about what's happening in the broader economy. Inflation is proving more persistent than central banks expected. Real interest rates are negative in many countries. Currency debasement is accelerating. In this environment, hard assets with genuine utility become increasingly valuable. Silver checks every box. There's also a generational shift happening in how people think about wealth preservation. Younger investors who've watched currency instability and financial system fragility are increasingly turning to tangible assets. Silver, with its lower price point compared to gold, is particularly attractive to this demographic. This represents a new source of demand that didn't exist in previous cycles. The renewable energy sector alone could absorb the entire annual silver mine supply within the next decade if current growth trends continue. Add in electric vehicles, 5G infrastructure, and other emerging technologies, and you have demand growth that's unprecedented in silver's history. This isn't speculation. These are projects already funded and under construction. Here's what keeps me up at night in the best way possible. The market hasn't priced any of this in yet. Silver is still trading like it's an abundant commodity with stable supply and demand. But the reality is completely different. We're heading into a period where silver could become genuinely scarce, and when markets wake up to that reality, the repricing could be violent. I've been studying commodity markets for years, and I've never seen a setup quite like this. The fundamentals are screaming shortage, the technicals are confirming a major trend change, and the macro environment is perfect for precious metals. If you're not paying attention to silver right now, you're missing what could be the trade of the decade. The secret event I mentioned at the beginning, those coordinated central bank actions, is just the catalyst. The real story is the structural supply-demand imbalance that's been building for years and is now reaching a critical point. When this breaks, and I believe it will, $200 silver won't seem outrageous. It might even seem conservative. So what does this mean for you? It means understanding that we're in a unique moment where a critical commodity is mispriced relative to its fundamentals. It means recognizing that the forces driving silver higher are structural, not cyclical. And it means considering whether physical silver deserves a place in your wealth preservation strategy. The opportunity in silver right now isn't about getting rich quick. It's about positioning yourself ahead of a major repricing in a critical commodity that the world desperately needs but doesn't have enough of. That's the kind of opportunity that comes along once or twice in a lifetime. The question is whether you'll recognize it before everyone else does.